Hello, everyone, and welcome to AUSTRAC's webinar on Australia's national risk assessments of money laundering, terrorism financing, and proliferation financing. My name is Steph, and with me today is Hong. We are both part of AUSTRAC's industry education and outreach team, and we'll be taking you through the findings on the risks posed to Australian sectors such as yours through money laundering, terrorism financing, and proliferation financing. For the remainder of this presentation, we will refer to these as ML, TF, and PF. AUSTRAC acknowledges the traditional custodians of country throughout Australia and their continuing connection to land, sea, and community. We pay our respects to elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples joining us today. Thank you all for taking the time to join us. The purpose of today's session is to provide you with contextual information on the scale and impact of the risks associated with ML, TF, and PF. This is information you need to meet your key compliance obligations under the AML-CTF Act. Understanding these risks is crucial in implementing effective systems and controls to protect your business and the greater community from criminal abuse. Before we begin, we have a few housekeeping items to address. This webinar highlights some key findings of the national risk assessments that may be relevant to your business, but we won't cover all of the information included. We encourage you to read these for a more fulsome understanding of ML, TF, and PF in Australia, as well as the specific vulnerabilities that may be relevant to your business's ML, TF, and PF risks. And finally, this webinar should not replace or form part of your staff AML-CTF risk awareness training program. And with that being said, I'll pass over to Hong.
Thank you, Steph. So this July, AUSTRAC published two new national risk assessments, one on money laundering and one on terrorism financing in Australia. In December 2022, AUSTRAC published a national risk assessment on proliferation financing. This is when a person makes available an asset, provides a financial service, or conducts a financial transaction that is intended to facilitate the proliferation of weapons of mass destruction, regardless of whether the activity occurs or is attempted. These risk assessments are an important contribution to Australia's anti-money laundering and counter-terrorism financing, or the AML-CTF regime. They bring together insights from across Australia's national intelligence, community, law enforcement, and regulatory agencies, private sector stakeholders, and international financial intelligence units to provide a contemporary, consolidated picture of Australia's risk environment. They also highlight where efforts to combat money laundering, terrorism financing, and proliferation financing can be improved. AUSTRAC completed these national risk assessments as Australia's financial intelligence unit. However, we would like to acknowledge over 50 partner agencies who make important contributions to the risk assessment, including law enforcement, intelligence agencies, regulators, social services, and taxation authorities at the Commonwealth and state level. When it comes to developing or updating your business ML-TF risk assessment, you must take into account AUSTRAC guidance and feedback that is relevant to your business ML-TF risks. This includes relevant information from the national risk assessments. The information in the national risk assessments and today's webinar is important to consider as it may alert you to risks that you were not aware of. Levels of risk are constantly changing, as are the crimes that generate illicit funds for the ML, TF, and PF activity. The risk assessments provide national and sector-wide views of ML, TF, and PF risks based on information not available to individual businesses or organizations. National or sector-wide ML, TF risks may impact on the particular ML, TF, and PF risks faced by your business or organization. Throughout today's webinar, you should consider how the information presented is relevant to your business.
We'll begin today's session by discussing the Money Laundering National Risk Assessment. ML is a major component of almost all criminal activity, and criminals continue to identify and exploit new opportunities to launder illicit funds through innovation, experimentation, and adaptation. Australia has a global reputation as a large, robust, and stable economy, which makes it an attractive destination for foreign proceeds of crime. Our strong trade and investment ties also creates vulnerabilities that are exploited by criminals. For example, asset classes that attract a higher volume of international investment, such as real estate, are also highly desirable as a means to transfer and store wealth. Now, in the context of this risk assessment, money laundering threats refers to predicate crimes that generate illicit proceeds, which are then laundered in, from, or through Australia. A predicate crime is any offence that generates proceeds of crime. You will see on the next slide a list of predicate crimes which have been rated high, medium, and low. An explanation of these ratings is on the screen. As well as ratings, on the next slide you'll also see an outlook assessment for each threat, which looks at the next 3 years. An explanation of each outlook rating is also included on the next slide.
Three of the highest money laundering threats identified in the risk assessments are illicit drugs, tax and revenue crime, and government-funded program fraud. These three risks are also assessed as increasing. I encourage you to read about them in the risk assessment, as there may be red flags you can include in your transaction monitoring program or employee risk awareness training to identify methodologies for these threats. I will be focusing on superannuation fraud for this part of the presentation. Superannuation fraud is assessed as posing a medium and stable money laundering threat. Superannuation fraud is typically committed in two ways. In the first scenario, an account owner makes a fraudulent claim for early release of their funds. This generally involves submitting numerous financial hardship claims for early withdrawal, falsifying documents, and conducting rollovers to other superannuation accounts or self-managed super funds. Criminal proceeds generated this way usually don't require laundering, as the individual simply withdraws and uses the funds for personal expenses. The second scenario involves criminals who illegally access superannuation accounts and submit fraudulent claims to access the funds. This type of fraud is mostly committed by serious and organised criminal groups, and criminal proceeds usually require laundering. Superannuation fraud can also occur in cases of elder abuse and financial abuse associated with domestic and family violence. However, while there is limited evidence of the scale of this activity, any individual criminal proceeds linked to these cases usually do not need to be laundered. Superannuation fraud is likely to remain a stable money laundering threat over the next 3 years. The fundamental role of superannuation for Australia's ageing population and the ongoing increase in superannuation balances will ensure this sector remains highly attractive to criminal individuals. Given that money laundering methodologies are used to move superannuation funds that are illegally accessed, the money laundering threat from superannuation fraud will remain an ongoing issue. Whilst the National Risk Assessment may be more recent, the Superannuation Threat Update AUSTRAC released in September 2022 provides more targeted details about the methodologies and typologies specific to this sector. Money laundering vulnerabilities exist across multiple levels, including national, sectoral, and channel levels. The risk assessment assigns a risk rating for the overall assessment of money laundering vulnerability for a number of sectors and channels. Channels refers to the way in which money is being laundered. For example, through cash-intensive businesses or through remote delivery channels, such as ATMs or internet and phone banking. You will see on the next slide a list of sectors and channels which have been rated very high, high, medium, low, and very low in terms of their money laundering vulnerability. On this slide, we have an explanation of the ratings. On the next slide, as well as ratings, you will see an outlook assessment for each sector and channel.
Non-bank lenders and financiers, custodians and asset custody services, and managed investment schemes have been assessed as posing a low ML vulnerability. While the risk assessment does not provide information on low-rated sectors, you may provide some of the same designated services as superannuation fund providers and stockbrokers and security dealers, which were identified to pose a medium ML vulnerability. Given this, The risk assessment findings we'll discuss for these sectors may still be relevant to your business and its risks. Additionally, while the low risk rating remains stable for some sectors, the outlook for non-bank lenders and financiers is noted as increasing. According to the 2021 MLTF risk assessment of the non-bank lending and financing sector, the level of MLTF vulnerability in the sector is medium. There are a number of factors that render the sector vulnerable to criminal misuse. For example, loans are well-established vehicles for money laundering. The increase in online delivery channels exposes the sector to cyber-enabled fraud, including via fraudulent online loan applications. And there are challenges in identifying suspicious matters due to limited oversight of some customers and transactions, such as cash deposits facilitated through third-party branches or agents, or due to the reliance on brokers and other external loan originators. We'd encourage you to read the 2021 MLTF risk assessment of the non-bank lending and financing sector for a more comprehensive overview of ML vulnerabilities. I'll now take you through the ML vulnerabilities identified for superannuation fund providers, which are assessed as posing a medium and stable ML vulnerability. The superannuation sector is vulnerable to criminal exploitation due to its larger customer base, use of remote and online delivery channels, and difficulties in verifying sources of funds for voluntary contributions. This limits visibility and allows criminals to conduct transactions without raising suspicion. Both APRA-regulated and self-managed superannuation funds are subject to the same access restrictions. However, APRA-regulated superannuation funds are likely less attractive to money launderers due to the involvement of an independent third party to release and invest the monies in these funds. Superannuation accounts will continue to be used to store criminal proceeds derived from other predicate offences, in particular fraud. The risk assessment also found that criminal proceeds can be placed into superannuation accounts via voluntary contributions. Superannuation accounts can be fraudulently accessed by individuals known to the member or by criminals using stolen identities. And illicit funds can then be stored or layered through staging accounts, then ultimately withdrawn as seemingly legitimate superannuation benefits or transferred to third-party accounts, including to accounts in foreign jurisdictions. The risk assessment also noted low SMR reporting from this sector, possibly as a result of the reduced visibility of customers and transactions driven by those remote or online delivery channels, the timing of conducting Knowing Your Customer or KYC procedures, and the outsourcing of administration and transaction monitoring processes to third parties. Superannuation funds will continue to pose a medium ML vulnerability over the next 3 years. And superannuation accounts will also continue being used to layer fraudulently obtained funds through rollover activities and ultimately access through the illegal use of early release schemes.
Thanks, Steph. I will now take you through money laundering vulnerabilities identified for stockbrokers and security dealers, which are assessed as posing a medium and stable money laundering vulnerability. Again, whilst the risk assessment findings relate to stockbrokers and security dealers, a number of designated services vulnerable to money laundering are also provided by trustees of managed investment schemes. As we talk about the findings of the risk assessment, you should consider how these may apply to the designated services you provide or the way you provide them. Stockbrokers and security dealers can be exploited by customers to generate criminal proceeds from fraudulent activities, such as market manipulation and insider trading, as well as tax evasion. In these instances, criminal proceeds are generally already placed in an investment product and are either withdrawn or layered and integrated into the wider financial ecosystem. The extent of observed money laundering by stockbrokers and security dealers is relatively low. However, the sector is exposed to a range of inherent money laundering vulnerabilities. These include exposure to high-risk customers and jurisdictions, and complex and increasingly remote online service delivery channels. The risk assessment found that stockbrokers and security dealers are at risk of being exposed to a range of money laundering vulnerabilities, including the volume and speed of transactions, combined with the increasing use of online services and trading platforms. This creates additional challenges for transaction monitoring. Reduced visibility of underlying customers in transactions, where there are multi-layered trading chains, legal persons and arrangements with complex ownership structures, the news of overseas-based agents, and funds transfer requests to third parties. The availability of services enabling off-market transfers, where ownership and value in shares can be transferred directly between entities, including across jurisdictions. Stockbrokers and security dealers will continue to pose a medium money laundering vulnerability over the next 3 years. They are unlikely to become highly attractive to criminals seeking to launder large volumes of illicit funds. However, they will continue to be exposed to inherent vulnerabilities. For stockbrokers and security dealers, the risk assessment also identified low SMR reporting. I want to emphasize that SMR reporting by your sector is an important mechanism to detect and report any potential suspicious matters to AUSTRAC. A further reminder, if you lodge a SAR with ASIC, you will still need to lodge an SMR with AUSTRAC. The National Risk Assessment also assessed the use of wealth and financial assets as a store of value mechanism, as posing a medium and stable money laundering vulnerability. This category of vulnerability includes the use of securities and derivatives, including fixed interest financial products and debt-based assets, APRA-regulated superannuation funds, and SMSFs for the purposes of storing value. Australians have access to a diverse range of wealth and financial assets, and each of these involve varying levels of risks, costs, and ease of money laundering. So the risk of criminal exploitation is dependent on the type and purpose of assets being used. The risk of criminals using securities and derivatives to legitimize and integrate illicit funds into the financial system is assessed as medium. For store of value purposes, criminals likely favor securities associated with a lower level of investment risk. Higher risk investments, such as derivatives, are likely more suitable for layering activity rather than for the long-term store of wealth. Low-risk securities carry a higher money laundering risk as they have more stability and are suitable for money holding over a longer period of time, including up to 30 years. Investing in low-risk securities provides a recurring income and requires minimal skill and expertise. In contrast, derivatives and high-risk securities require more knowledge of markets and expertise, given their high volatility, speculative nature, and potential for significant larger losses. They are likely more suitable for layering funds to create an appearance of gains or losses from trading activity, rather than for the longer-term store of wealth. Where securities are used for storing illicit funds, they can be held by opaque legal structures, such as shell companies, entities with straw directors, or entities incorporated in secrecy jurisdictions. The lack of transparency is ideal for holding illicit funds for long periods of time, whilst masking the true beneficial ownership and control of assets. The risk assessment noted superannuation funds are probably used to store criminal wealth to a lesser extent compared to other mechanisms. However, superannuation funds are still attractive to criminals for storing illicit funds. It requires very little skills or expertise to store criminal proceeds in superannuation products, and transaction may appear legitimate and therefore not trigger suspicion.
Now, let's take a look at a case study for the superannuation sector. Between April and July 2023, $500,000 was sent to a personal bank account, including $350,000 from the account of the SMSF. Around $500,000 was reportedly then transferred back to the SMSF account, an indication of layering. The SMSF trustee was referenced in 7 other SMRs between 2010 and 2023. The activity was linked to transfers involving a remitter and a currency exchange that itself was the subject of 30 SMRs between 2019 and 2023 for various concerns, including money laundering. Next, we'll take a look at a case study for the stockbrokers and securities sector. Between April and June 2022, an Australian company received nearly $12 million in domestic and international transfers. The funds were possibly obtained through investment scams targeting China-based WeChat and Alipay users. They appeared to finance transfers to online trading platforms that offer contracts for differences in commodities, such as digital currency, forex, and shares. Some of the online trading platforms are linked to financial secrecy jurisdictions and tax havens. These case studies highlight how your transaction monitoring and SMRs play a crucial role in helping AUSTRAC and our law enforcement partners to identify and stop criminal behaviour. As with money laundering, Australia is committed to ensuring the country and its financial system are resilient in preventing the financing and support of terrorism, both nationally and overseas. Australia combats TF through a well-established, robust counter-terrorism financing regime, which forms part of an important part of the country's national approach to countering terrorism and violent extremism in all forms. The Terrorism Financing in Australia National Risk Assessment is Australia's second comprehensive national risk assessment focused on TF, with the last report of this scale being completed in 2014. This risk assessment brings together insights to assess the risks associated with the methods and channels identified to finance and support terrorism activity. The TF process generally involves 3 distinct stages. 1. Raising funds through donations, self-funding, legitimate business, or criminal activity. 2. Moving funds to a terrorist network, organisation, cell or individual, or between such entities, including storing funds. And 3. Using funds for direct, operational, and indirect, organisational costs associated with terrorist activity. You'll see in the table on this slide, there is a list of channels and methods used for raising and moving funds. Self-funding remains the main method of ideological and religious TF in Australia and is assessed as high risk, which has remained stable since 2016. It generally involves very low to low value transactions, for example, between $5 and a few $1,000s. This and the fact that funds are almost always sourced through legitimate activity makes it very difficult to detect and distinguish from ordinary behaviour. The current overall risk rating for the superannuation funds to be exploited by threat actors for raising funds is rated as low for religiously motivated violent extremism and very low for ideologically motivated violent extremism. Other financial services were not identified in the risk assessment for this stage of TF. In terms of moving funds for TF, the small scale of TF in Australia and the use of less sophisticated methodologies means that only a few channels and methods appear to be exploited. Terrorist financiers prefer readily available and proven methods to move funds, such as banking, remittance, and online payment services, over more complex schemes. As you can see on this slide, the current overall risk rating for non-bank lenders and financiers to be exploited by threat actors for moving funds is rated as low for violent extremists across both spectrums. Stockbrokers and securities are rated as very low for violent extremists across both spectrums. Again, other financial services were not identified in the risk assessment for this stage of TF.
In December 2022, AUSTRAC published a national risk assessment on proliferation financing. The results of this risk assessment found that Australia is primarily targeted by state-based or linked procurement networks that wish to exploit a range of sectors to export restricted, sensitive, or dual-use goods and knowledge. Procurement networks targeting Australia operate on behalf of North Korea and Iran, as well as other countries of proliferation concern. Other significant proliferation financing threats include the use of third country nationals to facilitate proliferation financing and evade sanctions, and the exploitation of Australian citizens to source and export sensitive technologies and knowledge for use by actors of proliferation concern. All reporting entities must have risk-based systems and controls in their transaction monitoring programs to identify and report suspicious matters. This includes monitoring for suspicions that individuals or businesses are attempting to avoid Australia's sanctions laws in connection with the provision of a designated service or a request to provide a service. I encourage you to take the time to read the Proliferation Financing National Risk Assessment for a more fulsome picture of the threats and vulnerabilities identified and how these may relate to your business. Again, you must take into account AUSTRAC guidance and feedback that is relevant to your business MLTF risks when developing or updating your business risk assessment. AUSTRAC recently published updated guidance on taking AUSTRAC guidance and feedback on MLTF risks into account to help you assess your MLTF and PF risks. The updates include a range of guidance products AUSTRAC publishes on these risks. We've discussed a number of observations made during the risk assessments regarding the effectiveness of your AML-CTF frameworks, including your capacity to identify suspicious matters and report them. During recent supervision activities, AUSTRAC has also observed that transaction monitoring in the stockbrokers and securities sector often has a heavy focus on market manipulation risks, whilst gaps remain in the monitoring for money laundering risks. It's important to review your risk assessment and transaction monitoring program to ensure they appropriately capture the money laundering risks and methodologies outlined in the National Risk Assessment and Non-Bank Lending and Financing Sector Risk Assessment. Additionally, when outsourcing KYC, transaction monitoring, or other AML-CTF obligations to third parties, you must ensure these arrangements are fit for purpose and allow you to mitigate and manage your ML, TF, and PF risks and protect your business and customers. I encourage you to take the time to read this guidance as well as the national risk assessments to ensure you understand your business risk assessment obligations, your money laundering, terrorism financing, and proliferation financing risks, and the relevant AUSTRAC guidance and feedback that you need to consider.
We'd like to thank you all once again for joining us, and we hope you found this session informative and valuable. To access the national risk assessments or to find out more about your obligations, visit our website at austrac.gov.au.